Hello, everyone, and welcome to the next episode of our real estate impact of COVID-19. I'm John VanDuzer, CPA and partner with our real estate services team here at James Warren Company. And today I have the legendary Beau Beery, multifamily guru with Coldwell Banker Commercial M.M. Parrish. And Beau, he's a fellow Gator and is #1 multifamily producer in the state of Florida for Coldwell Banker, and it's been top 5 in the last in the nation for the last several years. So truly an honor to get to speak to you and chat with you. And today, if you can guess, we're going to talk about multifamily real estate and really what the impact has. This is, like I said, this is our 3rd video. If you've missed our other 2, go to our YouTube channel and check them out. One was on commercial real estate and the other one was on residential real estate. So we're trying to round out kind of all of the different areas to really understand the impact that's happening. So with that, we're going to dig right in. So Beau, why don't you give us an overview of the multifamily market? You know, what assets are trading per unit and other metrics?
Yeah, you bet. I'll be referring down to some documents I have in front of me, so forgive me for looking down a little bit, audience. Let me tell you what assets are trading for, and then I'll talk about kind of what's happened sort of post-COVID and kind of compare. Most of my closing stats I'm going to give you, while I do have several April and May closings in here, you have to understand that the April and May closings would have been under contract pre-COVID, right? So we don't have any impact on what the actual values are now. So I cover the northern half of Florida, not including Orlando and Tampa, because those are just totally separate worlds that trade at a whole different level. They trade like, I wouldn't say New York kind of style, but definitely a lot more than a lot of the other northern Florida markets. So I cover Polk County, which is Lakeland and Winter Haven. I cover Ocala, Gainesville, Volusia County, which is Daytona, New Smyrna, Ormond, DeLand, Orange City, up to St. Augustine, up to Jacksonville, over to Tallahassee, down to Lake City. So kind of that whole circle there. And I'll cover some of the little small cities in between, but I don't focus on them because, you know, you could add together 20 small cities to equal just Ocala. So in terms of apartments. So I'll read to you some stats that kind of combine all of those markets together. The overall closing price a unit for the trailing 12 months is about $73,000 a unit. That monthly rent is about $819, trading at about $94 a square foot. And for those of you who know what a gross rent multiple is trading at about 8.05. Now, a gross rent multiple is how many times the gross rent for a property trades into the price. Now, gross rent multiples is an old number. I use it as a macro sense. I don't use them in particular to value or price an individual asset, but they're great indicators when you're looking at big data. To dive a little bit deeper, Class A projects, and most of those are usually under 5 years old. Most of them are under 3 years old. So newer construction or new construction. Average age is about 2017, as a matter of fact. Trading at $212,000 a unit, right? So 2.5 times an already built average. About $1,560 a month rent. $175 a square foot, though I've seen many of the recent ones closer to $200 a foot. And the gross rent multiple is about 11.25. So that's a good 45% more than a general apartment complex. Now understand, what I like about gross rent multiples is it's basically the same dollar rent, right? So an investor is paying essentially 40% more than a regular complex for the same dollar of rent, just because it's newer.
So they're on the expenses then, right? So they're saying, okay, a newer asset, less upkeep, less maintenance, less sunk costs. I can afford to have a slimmer margin on my rents or pay more for those same rents.
Right, less risk. It's less
Yeah.
risk. Class B assets, you know, I follow B minus, B, and B plus. They range anywhere from 100 to 190,000 a unit, depending on where you are. And then on the C assets, you know, I track C minus, C, and C plus, and those range anywhere from about 40,000 to about 80,000 a unit. And those rents for the C's are, you know, it could be a $550 a month. That's obviously not a very good location. That's a C minus asset. Up to a C plus asset is around $800 a month. And most of the stuff that's in the C mark is 1970s, 1980s vintage. To round off the answer to your question, you know, we don't know what values have dipped to in multifamily after COVID, because, you know, if you think about this stuff has started in April, you know, it's going to be July, August before there's a closing. But I got to tell you, there's hardly any closings at all or new contracts that have happened after COVID. And we can go into that later on, why and so forth. But it's very, very slow, over 75 units. I do have broker friends that trade a lot under 50 units, and that has started back up. That's picked up a little bit more. It's easier to do inspections and tours and get inside people's homes on a 15 unit community rather than walking 250 units, right?
Right.
So anyway, I'll end there and wait for your next question.
So I guess, you know, going up to this, and we've spent some time and talked back in, you know, late January when we did the real estate forum, and the market was soaring, right? And everybody was just ecstatic with the level of activity and the trades and everything else. And so, you know, there's been so much happening in the last 5 years. What's left to sell?
Good question. I do have a chart for that. Let me find that. So coincidentally, I just ran a report 2 weeks ago. Tracy and I did, colleague that I work with, and I wanted to look at trailing 5 years, because that's really when the run up has really started, is 2015 and started taking off from there. How many assets have sold? What percentage of the inventory in any one city has sold in the trailing 5 years?
Right.
Because I wanted to see, like, how many assets are left that you could buy that haven't sold in the last 5 years. Because the likelihood of buying something that's sold in 15, 16, 17, or 18 for a reasonable price today and be able to buy it and add value to it is a little bit less, right? Usually, right. If it's older than 5 years, there's probably more value you can add. Now, listen, I've sold a ton of stuff that is sold in 15 and 16, and I sold it again in 19 and 20. But as a percentage, most trades, the ones people are most after are after 5 years. So, for instance, in Gainesville, if you look at 100 plus units, 29% of the inventory has already sold in the last 5 years. And when you look at that, there's only 50 apartment complexes that are non-student, non-affordable housing, so just a standard conventional apartment complex, as we call it. Over 100 units, there's only 50 left that haven't sold. Now, I would then dive deeper and I would look at, of those 50, how many have already refinanced in the last couple of years. Basically, if you've refinanced in the last, call it 2 years, that one probably can't sell because it's going to have defeasance. And for those of you who don't know what defeasance is, it's basically a prepayment penalty. And so defeasances are usually so high in apartment complexes, if it's in the last couple of years, you're talking it could be 7 figures to pay that off in order to be able to sell. Jacksonville, 59% of the inventory has sold. Lake City, 50%. And I'm talking about over 100 units. Lake City, 50%. Ocala, 85% of the complexes have sold. There's literally only 2 apartment complexes, conventional, over 100 units, that haven't sold. 2.
In 5 years. In the last 5 years.
In 5 years. Polk County has the greatest opportunities in Gainesville because only 30% have sold. The problem is that the balance, what you have is you only have 39 complexes. So percentage-wise, it's very low, and you would think there's opportunities there. And there is. It's because it's a smaller market, there's still a smaller number of opportunities. So for instance, in Jacksonville, I told you 59% of the market is traded. However, there's still 129 complexes that haven't sold. Now, you may think 129 is a lot. You have to understand, there are tens of thousands of investors from all over the country and from different countries that want to buy those 129 complexes, right? So the competition is very stiff. Tallahassee has had 73% sell. And I can go into the student side and the affordable side, but my point is that on average, 8% of inventory per year trades. So the average, if I did all this, should be around 45% for the entire northern half of Florida has already sold in the last 5 years. Bonkers!
Yeah, and then I guess a year from now, when we look at 2020 stats, the real big question mark is, did 8% trade, or did 4% trade, or what does that look like?
My prediction is it's going to be 5. That's my prediction. I just think that what I've read, I can only gauge by my phone calls and what I read, and there are other third-party information trackers that have said that deal flow has slowed 75%.
Wow.
That feels right to me. I mean, almost 2 weeks ago, I was at a point where I had literally sold everything that I had. I had no apartment complex for a short period of time in which I had to sell. Like, I really had no inventory to sell. And as real estate happens, all of a sudden now in the last 2 weeks, I've got several deals that I'm working on. I'm grateful to have them. They may all fall apart tomorrow, but the point is that many brokers on the multifamily side, it's slowed down quite a bit. Not because things have tanked, and we'll talk about that. It's just that sellers feel like, sellers are doing well in collecting rents. They're collecting the vast majority of all their rents. So to them, their value hasn't changed. But to the buyer, and we'll talk about this, many of them expect a discount, but there's no reason for it. There's no reason for it other than the financing component, which you and I will talk about here soon.
Right, which that kind of plays in. Expectations are a funny thing, and there's plenty of articles about our stock market that we now trade on news cycles instead of fundamentals. So expectations can really drive value, whether it's fair or unfair.
Right.
So kind of dig in about COVID. So one of the cool things you did, and I thought it was really amazing that you put it together and executed on it, was you surveyed, and gosh, you probably surveyed what? You sent it out to your list, but you probably got 150 responses back.
Yeah. Sent out to several hundred folks, and those several hundred folks own the vast majority of all these assets. So just to make you understand, every asset in all those markets I told you about, there are only 960 owners in the entire world that own every asset in the northern half of Florida. That's it, 960. And so I got 150 responses, which of the 150, many of them are big caliber players, so they represent a good majority of the assets there.
Yeah, so we got great coverage as far as the market. And you asked some really deep questions, really trying to drill in and understand patterns on, how is COVID affecting? So when you got the results back from that survey, what did you find the most surprising?
Probably the amount of rent collected. So I've got this minimized here. So I did the report in April, started it in April, which was the big month, right? That was going to be the first month where this all started. And I did it in May, and things got so good, so quick, that I didn't even do June or July. I recognized that everyone was collecting rent. So let me give you, for instance, in April, I asked, comparing current rent collections to meaning when I did this in April, so comparing April rent collections to January through March pre-COVID, how did you do? And when I add it all up, I've got, let's see here, I've got, 22, 38, 48, 58, 60, I think it was like 65% of, I think 65% of respondents collected at least 90% of rents or more.
Right.
Only 65%, which is not good, by the way. I mean, that's not good. That was in April. In May, it was 91%.
Right.
Collect 91%. I'm sorry. Yeah, it's 91% of rent collections were done. And so, and then in May, I asked, now that you've been through April and May, how do you think June will look? And let's see here, number of months. Let me find that question. Talks amongst yourself.
Well, I'll tell you, I mean, like that was a time, and I called a lot of my clients and a lot of the people I know that own multifamily, and I think we all were surprised a little bit because that would have been the gut reaction is you would have said, okay, businesses are going to keep on going on, but individuals who potentially are furloughed or laid off or are stuck at home may be more reluctant to pay their rent. And the surprise to me was it was the opposite, right? You had retail just being a bloodbath where you had public companies announcing that they weren't paying any rent in April. And then, you know, you took what normally would be probably a 5% delinquency rate. Now it's only a 10% delinquency rate. So that to me was just the most shocking thing was how little of an impact that some sectors of multifamily felt initially compared to other asset classes.
You gotta have a place to live. So when I was in April, I asked, how do you think May is gonna be compared to April? And only 33% of people thought it would be the same or better than April. Then in May, when I asked them how they thought June was gonna be compared to May, that became 73% thought June would be better than May. And so I was like, all right, we're done here. Nothing to see here. And it's been the truth. June has been even better. July, I think July, last report I saw was 96% of rent collected. So, you know, there's just 96% is probably about where it is anyway.
So one of the interesting responses or one of the interesting questions you had on your survey was, you know, if market conditions continue this way for 2, 3, 4, 5, 6 months, you know, when do I need to sell? And kind of discuss that and discuss, because I thought the responses around that were kind of interesting and it really was telling on who had reserves and who didn't.
Yeah, and it was a bit of a selfish question too, because while I did the survey anonymously, I wanted them to answer honestly, and I didn't want them to think that I was going to all of a sudden call up the people who said they need to sell now. I did want to understand, is there a problem here? Do we have some headwinds? And the answer was not really. So in April, I looked at the ones who said they have to sell in the next, let's call it 6 months. To me, those are the ones in the most trouble. And so in April, I had 13.6% of respondents said, yeah, I might need to sell in the next 6 months if things continue at the April rent collection.
Mm-hmm.
Now in May, that went down to 11%, so not a big change. However, those that no matter whether April and May continued or not at all, it was like 85% of people said, if this could go on forever, I would never need to sell.
Right.
So again, it was just another, and you know, these folks who, the ones who had to sell the next 3 months were only 4%. And so I felt like by you know, the end of May, when I completed the report, I don't need to do this in June, because the 4%, if June's going to be better, is probably going to be 2%. And I haven't resurveyed, but my guess is that's probably the case.
Right. Well, that makes total sense. So when we look at kind of the subsectors of multifamily, and I think loosely student housing, conventional, and affordable housing, who was the most impacted by COVID?
Student housing. You know, on the conventional, the student housing component was I talk to a lot of student housing managers and operators, and still continues to be this day the ones that are most affected. Now, there's still most rents are being collected, definitely in the 90th percentile as an overall average. But it's a combination of some kids feeling like if they're not there, they don't have to pay. There have been many cases in which some kids even organized kind of a grouping of multiple students that just banded together to not pay. And then of course, the unknowing of what was going to be happening with universities. Are they going to be fully open? Are they going to be a hybrid? Is it going to be online only? And so a lot of parents, of course, would call up and try to get out of it. But for the most seasoned student housing guys and a lot of the seasoned property managers, they have protocols they go through to weed out those who just don't want to pay versus those who can't pay, right?
Right.
Most of the vast majority of the time, anyone says they aren't going to pay rent, and I just interviewed an attorney on this, so it's his line. What they're really saying is they don't want to pay you before they pay this person, and buy this and buy that, right? Mm-hmm. And so you just have to weed through that and find the ones who are a single parent who is a waitress and just lost her job. That might be someone who you could work with, but in reality, they're very, very rare. Most folks are just not wanting to pay because they're not in the apartment, and that ain't gonna work.
Right. So to kind of switch gears a little bit, so we've talked about this, but how did your in-process deals fare when COVID hit? So everything that you had kind of everything that you kind of had in the hopper, in the pipeline, so to speak. What was your success rate, I guess, to get it across the finish line?
25% was my success rate. Yeah, I had. Luckily, I had a phenomenal year for the first 3 months. I mean, it was going to be another banner year for myself, production-wise. And at the time of COVID, I had, I think, I had 4 deals that were under contract and in different forms of where they were. I lost 3 of them. And when I say lost of them, all 3 of them will still be brought back to life at a later date. I'll explain why it's not now. But I did keep one of them. That one's already gone non-refundable and closed. I do have another 8 deals that are in the hopper, so that's nice. But as far as at that time, it was horrible. And the main issue was, you couldn't. You don't know when you could do inspections. You don't know when you could get inside units. Lenders were already jacking up how much in escrow they wanted up front. So everyone's returns, their cash-on-cash returns, were becoming different, and the uncertainty just creates stalemate, right?
Yeah.
It was a horrible couple of weeks. And it was funny at the time. I just thought, this is going to be, we'll give it a couple weeks. We'll revisit this, and it just didn't happen.
I think we all thought that to some degree, and here we are in July, and we're still trucking along.
But of any field to be in, multifamily, what I love about it is it's shown its resiliency. I definitely chose the right career path, and all those who were in it. A lot of my friends who are doing retail and restaurants and hotel, not so much, right? And so we're already coming back in multifamily. It's slower, but I think it's going to be just fine long term.
Right, and that's the reality, is people have to have somewhere to live. And with the cost of, we again watch our video from last week on residential market. The residential market's on fire. And there is no inventory, and costs are rising, and when you look at that, it set multifamily up to also kind of follow suit, irrespective of a pandemic and that sort of thing. So you talked about it a little bit, but tell us about new deals in May, June, July. Like recently, have you seen an uptick in activity now that we've kind of settled into this new normal?
In the under 50 unit stuff, yes. I've got several of those in the hoppers and the broker friends I know about. I actually have a couple of multifamily land deals that have gotten a ton of activity. Anything over 75 units is still very, very slow. And it's driving me crazy because I'm trying to talk to sellers that, one of the questions in my May survey was, how much off the price would you need in order to do a deal? And 63% of investors said they would pay 90 to 100% of pre-COVID value. My guess is in June, it's probably more like 95 to 100%. Right. And 63% is probably more like 80 or 90%, right? So I think it's gone up dramatically. So most buyers will pay what it's worth, but the question is, will they put their money where their mouth is? And sellers still feel like it's not, they don't want to get tied up with any kind of COVID clauses, which state that they can postpone, due diligence and closings if the government shuts down. So if you're a seller, why would you go to a contract with an open end date? I'm seeing less of the COVID inserts, so that's good. I think that's the reason why we're going to recover quicker. And I do believe, at least in my mind, I think sellers are getting a little more comfortable with they're going to get paid what they should, but it's still very, very slow over 75 units. I'm trying to tell sellers, listen, there have been no deals to come on the market. When I say no deals, like hardly any deals come on the market in the last 90 days, and there's no less money out there to buy. In fact, there's tons, the same amount of money is still out there. These same people who are collecting 96% of their rents, they have the same amount of money. They're not hurting. In fact, their money is so freaking hungry, it's nuts because it's been sitting for 90 days. And so I'm trying to tell the sellers, like, guys, if you list now, if you come on the market, you will be alone. You will have so many investors wanting your asset right now. I think that alone has the possibility of driving up value just because of low supply. I listened to Lisa Petro on the single family side when you interviewed her the last couple of days. It's exactly the same thing. Inventory's down 30% for them. For us, it's down even more than that. And when inventory's down, you have low supply, you have high demand, you have up prices, right? So it's the same thing.
Yeah. Now, one of the things that I think, I've been kind of conscious of and really thinking about and wondering is, when everything hit in March, there were a lot of government type incentives and pretty much most of the banks were willing to give a forbearance for 90 days or so. And you start doing the math and we're at the end and just past the end of the 90 days of kind of relief. What impact has that had? I mean, I guess for those sellers that would have to sell, I would think we're getting pretty close to that time where it's, those pressures are kind of coming back.
Yeah, I mean, I don't know the answer to the question. So far, there hasn't been any impact. However the dates align for the ones who are supposed to end in July. Like I said, 96% of rents are being collected, so there hasn't been an issue in that regard. Will it happen in August, September? I don't know. I mean, because the unemployment rate has already come down so much. And so, those who are still unemployed, are they in affordable housing projects that the government's already paying their rent? Like the affordable housing guys, by the way, are probably the ones who are faring best, right? There's a lot of government checks coming in. They haven't really suffered all that much at all. Mm-hmm. That and on the non-affordable, non-student, but sort of that middle rent range, that whole, call it $750 to $950 a month range, those guys have done very well, right? Mm-hmm. It's a good affordable type deal. I don't know what the impacts will be on that. My tend to guess is that it's not going to have much of an impact just because we all thought that, April and May were going to be catastrophic on rent collections and they weren't. And so I'm just going to err on the side of, positivity here that I don't think it's going to be much of an impact. I just don't. You still got to pay your rent. You may not pay your car payment. You may not pay your utility bill. You may not buy your kid an iPad, but you're going to pay your freaking rent.
That's great. So, and you mentioned this a little bit that you had some land sales. So what does new multifamily development prospects look like, and what does that look like?
Yeah, I've got let me tell you kind of what they trade for, because that's some promising stuff. So I've got, I don't know, I've got, call it 8 or 10 comps here for the North Florida region that were constructed in 2017, 18, and 19 and have sold, right?
Mm-hmm.
So there's obviously a lot more that have been built in 17, 18, 19, they just haven't sold yet.
Right.
So the ones that have been built in and actually sold, the metrics are pretty good. So those are, and I kind of went over this in the previous slide, but these are Class A, so they're selling at about $208,000 a unit. Average age is around 2018. You got 1,520 a month rents. Average size, square footage is about 1,100 square foot per unit. And they're trading at 11.31 gross rent multiple at $185 a square foot. And so I say all these metrics because, on the land development side, because those metrics are still strong. And I believe, by the way, new construction, 95+% occupied apartment complexes, which will happen, are not hard to sell, right? People want those. Mm-hmm. Especially now, people want stability, right? So a lot of bigger companies, they love nice, stable new construction projects. So you can buy land for, in good locations, it's going to run you $12,000 to $18,000 a unit land cost. Obviously, if it's a super special, and this is for conventional, not student. Mm-hmm. If it's a really special, maybe it's downtown somewhere in Orlando, whatever. It probably does get into the 20s and 30s a unit for the land cost. But in general, for secondary and tertiary markets, a good site, 12 to 18,000. Affordable housing will be, call it $6,000 to $10,000 or $12,000 a unit. And then when you throw in the construction costs, by the time you get done with all that and you do the lease up, there's still plenty of profitability there when you're selling over $200,000 a unit. So generally speaking, for instance, I got a new listing I just got in the last couple of weeks. I'm already working with 11 buyers on it. I know 4 of them who are talking about they're going to turn in an offer. The thing is that in secondary markets and primary markets, so much has been developed that over the years that the land that's left, it's rare now to find land that doesn't have a little bit of hair on it, right? In other words, the perfect piece of land is one that's already entitled, the zoning's in place, the utilities are there, doesn't have bad soils, doesn't have a lot of trees you have to mitigate, it's not next to a gas station, all the stuff. Those being available, very, very, very rare. Almost everything you do now has something you have to deal with, right? And so, but you don't know the depth of it until you get into due diligence and do a study. And so I think most sellers who are in the know these days, sellers of multifamily land, probably know they have something's going to come up during due diligence, and most of them know to be flexible, right? So what I tell buyers is, let's go in and let's have a conversation with the seller that, hey, I think your price is legit. As long as there's not problems, I'm going to pay you the full price. I just need you to be flexible. And if I show you legitimately with it from an engineer, and by the way, seller, you can hire your own engineer and confirm my engineer's report. But if I can legitimately show you that you have this and this going on, and it's going to cost X, let's have a conversation, right? Just because when you develop that many pieces of land, and you build that many units, what's left is the second pickings. But I think development prospects are still there. There's still plenty of demand for the end product. And if you can find the dirt, build it.
Yeah, no, that's great. So let's shift gears a little bit and talk about student housing. And in full kind of disclosure, so just before this call, literally 2 hours ago, a major university kind of released what their fall plan was. And so I had a chat with our higher ed group. So James Moore has a higher ed group solely focused on servicing the higher ed clients across the country.
Of course you guys do, you're the best.
And they are, they're looking at it from all ends, like we have a big practice in athletics and in other things, and trying to understand what's going to happen with all of these groups as time progresses. So the big question mark is, whatever happens to those universities in some form or fashion is going to trickle down and affect student housing. And so really kind of the question is what is going on in student housing? And I think your survey spoke to pre-leasing for the fall semester. So what were the results of that?
Yeah, and I've subsequently talked to a lot of students. I talk to student housing guys all the time, both owners and managers. And so leading up to today, right? So today is going to change a lot of things now that university plans have come out. But up to today, if you were walking distance to campus student housing, most of those are, call it 80 to 95% pre-leased. Now, that may sound pretty good, but you have to understand that ain't good. And the reason is
there's normally a waiting list.
Yeah, like, walking distance and even biking distance student housing is like 95 to 100% pre-leased in December, okay, in normal years, in December. So to be where we are right now in freaking mid-July is nuts. Now that the universities released their plans, it depends on really what college you're in, right? Because even within the universities, there are different colleges within the universities. Some of the colleges are going to be fully online, some are going to be hybrid, some are going to be open, right? So we don't know how many will actually show up in the respective city and rent an apartment and go to class versus staying at home and going online or whatever, right? So the last 2 weeks, the student housing guys have told me leasing has increased a lot. Now, if you're driving distance away student housing, those guys were anywhere in the 70, actually mid 60s to almost 90% pre-leased, right? There were a few anomalies that were in the 90s, but most of them were in the 60s, 70s, and 80s pre-leased, which is not great. But all of those guys said that pre-leasing has really picked up. We're talking 60 or 70 leases in a week at some of these properties in the last couple weeks. What I don't know now, because this report literally just came out today, you and I saw like an hour beforehand, is how many students how many students are in some of these colleges within the university that are still going to end up renting an apartment, right? And my understanding is that it could be all the way to the end of August before you know who's actually going to rent an apartment. You could be enrolled in class, but you still don't know as a student housing guy if the person's actually going to move to Gainesville or to Tallahassee or whatever and then still rent an apartment. And I think the next literally 7 to 14 days will tell us what that looks like. My guess is they could be getting a lot of calls right now, or it could be tumbleweed. I just don't know. I can't wait for the next few days to make those phone calls.
For sure. And that's kind of a nationwide thing as we look at, even college athletics. The Ivy League came out and said they're not going to do fall sports. When you have other conferences saying we're going to play only conference games, you have other conferences that are basically saying we're still silent and waiting to see what's going to happen. Obviously, all of that has a domino effect, when it comes to housing and the overall university operations. And it's just a real uncertain time in that area. Have you noticed any rent concessions or anything like that? So the way I look at it is there's going to be some decrease in demand, for student housing if people are staying home. And we don't know what that is, but I'm assuming it's going to be some. So then it seems to me that there will be some race to be able to fill each complex and to be able to recoup some of that revenue. So have you seen any rent concessions, or have you seen any patterns around that at all? I've
talked to the student housing guys and the managers. They said as of now, not many concessions. It's mostly been, they said they're waiving fees, application fee, a pet fee, maybe a redecoration fee, just some of the little Chauncey stuff has been waived. But they've told me, as far as rent concessions, giving away a motor scooter or a computer, that's not happening yet. Now, they said, once you get down into the August timeframe, as you get closer, depending on what the world looks like and how many calls they're going to get right now, there could be.
Yeah. So that's a indicator of, I think, this year, right? Is we're going to wait and see.
Yeah. It's game changer when it comes out an hour before our call.
Yeah. So to shift gears a little bit and talk about lending, and next week our video is actually going to be with a banker and to talk about lending.
Cool.
But how are banks underwriting nowadays compared to January?
So student housing is a bad word right now, just because, again, there's uncertainty. They don't know who's going to show up and who's going to rent apartments. And so especially Fannie and Freddie, it would be very difficult to get any student deal financed on the buy side. I think for maybe small, like I have a couple of smaller projects, like under 50 units that I'm talking to buyers on. Lenders are open to that. Might be a little bit of a higher, a lower loan to value in order to get into it. But student housing is kind of a bad word right now to lenders. On the conventional side, there's still plenty of capital that they would love to lend, all good. What they're doing, though, to kind of curb some of the risk is they started off in April and May wanting, and this is insane, 12 months of principal and interest payments upfront in escrow, okay? Then it got down to 9. Now it's currently, right now, 6 months, okay? Mm-hmm. Now, what that does is, as an investor, when you're calculating cash flow rate of return. So cash flow rate of return that's your rate of return after all expenses of the property are paid and your debt. So the actual money in your pocket before taxes is your cash on cash return. Most investors these days want 7 to 8%, right? 8% has been the gold standard. These days it's around 7 because the deals are so sought after. So I did an analysis prior, and I was talking to you about this prior to the call. I did an analysis and compared, okay, because I have a lot of buyers saying, hey, Beau, I think I might have to offer a little bit less because I'm having to put up to 6 months into escrow. And so I thought to myself, okay, well, that doesn't sound like a lot of money, so let me actually do the calculation. So I did the calculations. I compared. First of all, I created a spreadsheet that solved for an 8% cash on cash return on a $10 million purchase. I used debt information of 70% loan to value. I did a 3% rate on a 30-year ammo, which is completely reasonable right now. And I solved for 8% cash on cash. Then I did it to where I added in 6 months of escrow as a closing cost, right? And when I played with the price to solve for the same 8% cash on cash, it's only a 2.75% reduction in price that one would need to make up for that 6 months. Now, 2.75%, first of all, what is silly is that you're going to get the 6 months back. Probably after a year of owning it, you're going to get the 6 months back, right? So it's not actually a closing cost because you're going to get it back. But let's just say that a lot of these buyers or syndicators, they use other people's investments, and so they've already put together the package, and they can't go back and change things afterward. And so my point is that at 97.25% of asking price, hell, that's what we're trading at anyway before COVID. I mean, if I had a $10 million deal and someone came in at, whatever that is, $9,750,000, are we going to not do a deal? No, we're probably going to do a deal. Probably going to do a deal with 9.5, depending on the circumstances. So the excuse of, and first of all, if you're buying something in which your margins are so small that a 2.75% reduction in price doesn't make it work, that scares me as well. All right. Mm-hmm. So anyway, the lending has changed some, sure, but it's not that big of an impact if you do the math.
Well, that makes sense.
Unconventional.
Unconventional. So what about, and I've asked this on every one, about innovation. How have landlords and management companies had to innovate through all of this?
I mean, it's the common sense stuff. A lot of it's virtual tours, it's wearing masks, it's social distancing, it's posting notices on doors with a better explanation. So pre-COVID, if someone needed to do preventative maintenance, right, the leasing and the maintenance crew would post notices on the doors that says, hey, we're going to be coming in your unit tomorrow to maintain the air conditioner or to do whatever, right?
Mm-hmm.
Now it's, hey, we're coming in tomorrow, you know, we're going to be wearing a mask, we will put on gloves, we'll put on booties, we're not going to touch anything. Please keep your interior doors open so we don't even have to open them. If you're not going to be there, even better. You know, that kind of stuff, like, you know, or if you don't want to be there, you don't have to be there. That's the changes. And frankly, I think it's probably going to be here for a while. I mean, you know, just, I don't know, something like this, I believe, stains the mind for a little bit. Even if we come up with an antidote for this, you know, you're still going to feel like, shoot, this could happen. Like, what's to stop something else like this coming up? So I think there's just going to be, in general, more hand washing and not being in giant parties. And I hate to say it, but I don't know how many people are going to be showing up to football games anymore with 80,000 people. I don't know.
Yeah, no, I think that's exactly right. And I think that as time goes on and it settles more, I think we've been able to innovate. So one of the interesting things is videos like this, you know, probably 6 months ago, probably wouldn't have made as much sense as they do today. We're just about out of time, but before we did, you're working on a pretty big project right now, and you just launched maybe a couple weeks ago. So I want to give you a chance to tell us about your YouTube channel.
Oh, yeah, cool. So, you know, I've had a YouTube channel, John, for, I don't know, 6 or 7 years, but, you know, as a realtor, you have a YouTube channel because you do a couple walkthroughs, or maybe you post some video about a closing or something. So I had many years, but when COVID hit in April, you know, everyone's watching more YouTube channels, right? And so I'm watching more YouTube channels, and I'm seeing the way other realtors are using the platform in different markets, and they have a tremendous following and a lot of views, and you know, a whole side story that we could do a video on is just, you know, the incomes a lot of folks are making off YouTube, right? I'm in it for education. I love to educate my customers. I love to keep my customers up to date on the most, on the best information, the intel, the closing prices. So I started a channel. It's under Beau Beery, if you look it up, and it's all for multifamily investors. It's how to buy it, how to sell them, operate them, finance them, underwrite them, you know, everything you can think of. And, you know, there's some material on there for beginners, but it's mostly intermediate to advanced level stuff. The videos that are on there now are kind of what my capabilities are with video and audio, so it's kind of substandard, but I'm really excited because I just signed a deal with a videography company that we'll be starting with the next couple of weeks, that we're going to take our videos to the next level in terms of quality and making a lot more, be doing a lot more property tours. And so I'll be announcing oftentimes new listings that are just brand new, that haven't even been sent to anyone, they haven't gone on any website, they haven't been emailed to anybody. Like, if you're a subscriber to my channel, you could be one of the first ones to see any of my new listings. And so the videos will be done a lot more in depth now. The technology is amazing with the cameras and the audio, and so we'll be walking into units, we'll be doing aerials with the drones. I've got my first one coming up. I've got a property coming up in Gainesville here soon. So anyway, I'm excited about it. It's kind of the new thing that's come up as a matter of COVID, and frankly, I think this video and the YouTube is going to be the future. I think a lot of stuff's going to be done that way. So please, if you could look me up, if you're a YouTuber, if you go into YouTube, you watch videos, subscribe to me. I'll be doing one video a week. I promise I'm not going to, infiltrate your inbox, and I promise you it'll be high value stuff that you'll like.
Oh, and I can totally say I've seen the videos that you put out so far, and I think they're well done. So great job on that. It's a pretty cool project.
Thanks, man.
So I think we're about out of time, but I just want to tell you thank you so much for coming and joining today. A lot of information. I think there's still a lot going on and a lot to follow. So I'm pretty excited to see kind of what happens in the next few months.
Yeah, man, you bet.
All right.
I agree.
So next week we'll have like I said, a banker meet with us and join and chat with us, and we can kind of drill into more of these lending topics that we've been accumulating over the past few weeks, and look forward to it next time. Thanks. Bye, guys.
Awesome.